anyone who knows of Warren Buffett, he made $1 million bet, and he had this bet with fund managers. And he said, hey, listen, I'm pretty sure that you're not going to be able to beat the S&P 500, which is the benchmark when it comes to investing in US stocks. And sure enough, no one was able to beat him over a 10-year period. So sometimes fund managers can outperform the benchmark, maybe 1 year, 3 years, but it's really hard to be consistent over a long period of time.
The Get Rich Slow Club podcast is a collaboration between Tash Etchman from Tash Invest and Anna Christina from Perla. The Get Rich Slow Club acknowledges the traditional custodians of the land we record on. From coast to coast, across land, waters, and communities, we pay our respects to elders past, present, and emerging. Any advice is general and does not consider your financial situation, needs, or objectives, so consider whether it's appropriate for you.
Welcome to the Get Rich Slow Club podcast,
where we take you from beginner to confident investor,
where we can teach you everything you need to know about investing.
So come get rich slow with us. Welcome back. Today's episode, we're discussing ETFs, so exchange traded funds, versus managed funds.
I feel like these are always really confused, or they're used interchangeably sometimes, kind of with like index funds as well. So we'll get into the differences and which one you might buy and why. But first, money wins, money losses.
All right. Well, I'll kick it off. We're recording this right around Black Friday. So I have definitely taken advantage of some Black Friday sales. And there's a couple other things that I need to purchase that I haven't. So what we do in our household is we literally have a list on our phone of all the things we need. And often they're like big ticket items. In the past on Black Friday, we've bought a slow cooker, a vacuum, a coffee machine. So like bigger, more expensive items, but they usually go on sale. So we wait all year for this time and then we blow a lot of money. So yeah, I've definitely taken advantage of some of the sales. I also make sure to use cashback, cash rewards. I use Honeys for the promo codes. So just knocking off all those things off the list and making sure I get a deal.
What's an example of one thing you've bought?
Okay, so this is not going to sound very exciting, but I bought pillow protectors.
Okay.
You know what I mean? Like a mattress protector. But I got king size pillows, and it's really hard to find like that size pillow protectors. It's not hard, but it's not as common. So anyways, they went on sale and they're getting delivered today. I saw on my
very
phone.
Exciting.
Bought some sunglasses, but the other things on our list is a heat pump dryer, which is quite expensive. But we have solar panels, so we're trying to take advantage of the electricity and
amazing.
Yeah.
All the things.
Very domestic house stuff. But yeah, it adds up.
I've got a house one. We bought a king bed because I wanted more space, and we've had it for a little while now, and it is so worth it.
It is so worth it. We got one too when we moved into our house. We needed some new furniture, and we're like, king is king. King is queen. King is king.
King is
so
worth
good.
it. I thought it wouldn't. I was like, it's only like 30 or 40 centimeters difference. Like, will that make much of a difference? But it feels like completely different.
So you're fairly tall. Your partner's tall. My partner's tall. So it's nice to have that space. And sometimes you just want to watch a show in bed.
Yeah.
Not with your partner. So with two laptops.
I like to have things next to me. I like to have my like Kindle when I go to sleep on my phone, or like I like to put my glasses just on the corner of my mattress. In a hotel, it's so good. But then I was like, it's too close and too warm, and I want space to cool down, and I can't put my things next to me. But now there's so much room.
Yeah. Well, it depends if you have the room. Like we didn't have the space before when we were living in a small
we
apartment.
didn't our other one either.
Yeah. And now we have the space, and it is a big win.
Yes. Worth it. So much so.
Awesome. So let's kick it off. Managed funds versus ETFs. So again, ETFs are exchange traded funds. And these two are often discussed as one, right? Like sometimes people confuse them, but there are differences between the two. So
especially when you say like managed fund and then you say exchange traded fund, like they're both funds.
Yeah, they're both funds.
And they're both managed. In a way.
In a certain way, right? So let's first talk about ETFs. So what they are is essentially they're a fund that tracks the performance of a specific market, index, or sector. So for example, there are ETFs that track the S&P 500 or the ASX 200. Or you can have ones that track the tech sector, right? So similar to managed funds, they pool people's money together. They invest in a diverse basket of assets, but they aren't usually actively managed.
But they can be, to make it confusing.
Yeah, but they can be. Usually though, ETFs are passively managed, so they aim to replicate the performance of an underlying index or a sector.
Managed funds, similar in some ways, they are investment vehicles or baskets in which a fund manager pulls money together from multiple different investors and then allocates the funds to a different range of assets. These can be shares, bonds, or other types of securities. Managed funds are typically overseen by a professional fund manager, so a human who might be like, we're going to target high dividends or whatever it is.
So not to make it confusing, but these two funds, one is usually more passive, which is the exchange traded funds, and managed funds are usually managed by someone.
And then there's some small details on how they are kind of structured as well and how you can buy and sell them as well. We'll get into that.
Yeah, so let's talk a little bit about trading and liquidity, and they work slightly differently. So for example, managed funds are typically bought and sold at the end of each trading day with the fund's net asset value. So that's called a NAV usually. So you'll see it, NAV, calculated, and that's calculated at the end of the day. So this means that investors can't trade managed funds throughout the day, and they must wait until the end of the day to trade or to buy and sell their units. And then furthermore, managed funds may have a minimum investment requirement, and there's restrictions to the frequency of the transaction around them as well.
ETFs, on the other hand, they trade on a stock exchange. So like the ASX, for example, the Australian Stock Exchange, in the same way as individual stocks. So you can buy and sell them throughout the trading day at prices determined by the market. This provides ETF investors with increased liquidity and flexibility compared to managed funds. ETFs also kind of have no minimum investment requirements, but it depends on which market it is. Like on the ASX with Perla, for example, it's often a minimum of $500, but a lot of managed funds will sometimes have like 50 grand or 100 grand if you're getting into those more like higher end funds.
Yeah. There is a lot to consider between this two. The other one is fees and expenses. So with managed funds, they generally do have higher fees and expenses than ETFs. And this is due to the fact that they're usually actively managed. Investors expect to pay these higher fees because it covers kind of the cost of the management of that specific fund. So for example, if you're looking to try to beat the market, or you're looking at investing in specific ethical funds, chances are that someone has to manage that. Someone has to look at the companies, has to choose that. And because you actively have someone looking at all this data, making these choices, you're going to have to pay more for that as well.
ETFs tend to have lower fees and expenses compared to managed funds because they are often passively managed, but this can get confusing because again, like you can have active ETFs and active managed funds, and you can have passive ETFs as well. Most ETFs charge lower expense ratios, and many do not have things such as sale loads or redemption fees. However, ETF investors do need to pay a brokerage fee when buying and selling ETFs on a stock exchange.
Yeah, no, all of that is fair because managed funds may charge those sales loads, redemption fees, and other administrative fees. So it can impact the overall return that the investor gets. Now, what about performance and benchmarking?
Managed funds are actively managed with the goal of outperforming a specific benchmark or index. However, studies have shown that a significant number of actively managed funds underperform the benchmarks over the long term. This is partly due to the higher fees we just spoke about associated with the active management. Additionally, managed funds are more likely to deviate from their benchmark due to active decisions made by the fund manager.
Yeah, this is a really interesting point because anyone who knows of Warren Buffett, he made $1 million bet, and he had this bet with fund managers, and he said, hey, listen, I'm pretty sure that you're not going to be able to beat the S&P 500, which is the benchmark when it comes to investing in US stocks, inclusive of fees and all of these fund fees. And sure enough, no one was able to beat him over a 10-year period. So sometimes fund managers can outperform the benchmark, maybe 1 year, 3 years, but it's really hard to be consistent over a long period of time.
ETFs, on the other hand, often aim to replicate the performance of the underlying index or sector rather than actually outperform it. As a result, the performance of an ETF is generally more predictable and closely aligned with its benchmark. Due to the passive management, ETFs tend to have lower tracking errors, which is the difference between the fund's performance and the performance of its benchmark.
Yeah, and that's why a lot of people do like to invest in ETFs. You're just going to get the average returns, and investing average is all right.
It's pretty good. Yeah, it's hard to beat the average.
Yeah, over the last 30 years, the Australian market has turned around 9%, whereas the US international market has been around 11%. Mm-hmm. And that's over the last 30 years. So for the most part, I'm okay with average.
So what about tax?
So with managed funds, they are subject to capital gains tax when the fund manager buys and sells securities within the fund. These transactions can generate capital gains, which are then distributed to the fund's shareholders. Investors are required to pay taxes on these capital gain distributions, and even if they have not sold their shares in the fund. And this can result in a tax liability for the investor, which can affect their net returns.
ETFs, on the other hand, generally offer more tax efficiency compared to managed funds. Investors typically incur capital gains tax only when they sell their ETFs, allowing them to defer the tax until they choose to actually sell and exit their investments. The way ETFs are bought and sold minimizes taxable events actually within the ETF, as it generally does not trigger capital gains distributions. Therefore, ETFs can help investors better manage their tax liabilities and potentially even enhance their after-tax returns compared to managed funds. In summary, it's just saying you have a bit more control over it because you can pay it at the end.
Yeah. But at the end of the day, it's like much.
Yeah. Let's compare, because I feel like managed funds were kind of more of a, not olden day, but a thing from the past a little bit. And now ETFs are available. They're a lot more transparent. They are mostly like passively managed. You can kind of see what they're trying to attempt to do. Like it's just a lot more transparent, I feel. But I was having a look at VAS. So you can buy VAS, the Vanguard Australian Shares Index Fund, as an ETF, but also as a managed fund. So the ETF management fees are 0.07% per year, but then the managed fund management fees are 0.16% per year. And they're pretty much like the same thing, tracking the same index. But then one has a higher management fee because it's managed fund.
Did you know that I actually held managed funds back in the day?
Oh, interesting.
Yeah. So when I didn't really know about investing, so it's funny because when people say, when did you start investing? Like I've been investing also for like maybe since I was 19, but I don't think of it as investing because in Canada we have like the equivalent of a super, but you kind of have to manage it yourself. And at that time, all I knew was I needed to invest, but I didn't know what that meant. And banks usually set that up for you. So it's not actually like a super fund. And when I went in, I was like, what should I invest in? They're like, well, you should be in these managed funds. And I was like, great. So I was actually investing in these managed funds for many years, not really knowing what I was investing in. It was only when I really dove into investing and understood the fees associated with investing that I kind of took a step back and tried to figure out ETFs because that wasn't really talked about at that time. Anyhow, long story short is my managed fund was like 1.5% that I was paying.
Oh, wow.
Yeah.
Crazy. Yeah.
That and that's like for anyone who's listening, if you're thinking like 1.5, that doesn't sound like a lot. That's because we're used to credit cards that are charging us 19%, yeah, 23%. But actually that can eat at your returns quite a bit. That can be hundreds of thousands of dollars over the course of your life. So it is really important to be aware of what those fees are. Now fees are less than 1%. And in Canada, we have some of the highest fees around like 2.5 or something like that.
Huge.
Yeah. So anyways, I was invested in managed funds, not knowing what I was invested in. And when I look back, I was like, I didn't know what I was doing. At least I was doing the right thing. Like the actions were right. I was investing. I was seeing some returns, maybe. I don't know. It was probably around the GFC. So maybe it was in the negative, but nonetheless, it's a learning journey.
Yeah. I think like there's two, like just off the top of my head really quickly, there's two kind of groups of people that I'd see fit managed funds really well. So it's people who have just started investing and they want a micro investing platform. Often they are managed funds. So you might not have the full $500 to buy like a full amount of shares on the ASX. So you put like $5 into a micro account. If like the companies will need to pull your money together to actually have enough to buy a full share probably. So managed funds are great for micro investing. And also if you are like a more sophisticated investor, you've got a lot more invested and you want to kind of explore outside of like the ASX 200 and the S&P 500, that might be when you look towards managed funds for like something really specific or niche or like you were saying ethically. But if you're like us, I feel like ETFs are just buy an ETF. There's no need to overcomplicate it too much.
There were some managed funds that I was looking at a little bit more actively, and they were some of the more ethical ones. So ESG investing, which is environmental, social, and governance. And I really wanted to invest in some that were really focused on climate change and focused on supporting more renewable kind of sources. Now, with that, if you're going to invest in managed funds, it is going to cost you more because someone has to go through all of these companies, see which ones are actually ticking off the list, all of the good ethical, environmental, ESG stuff. And because of that, it's going to cost more. So there are situations where that might be of interest if you are in a specific niche thing, a specific sector that you want to follow. And it's just really hard to kind of get that within a ETF.
Yeah, like one of those situations where you want a human to actively pick it because mostly we don't want them to because we're like, it doesn't win out of the long term. But there are those specific examples, like especially with ethics, because it can vary so much where you want a human being like, is this company doing the right thing? Are they benefiting whatever it is or are they not?
Yeah. And you need someone to kind of track that and figure out what companies fit and don't. So there are lots of pros and cons to why you would invest in either. And actually your comment on micro investing is a really valid one because that's the only way you can actually access micro products, right? They're managed funds that kind of pool people's money together, pool like different funds together to make it more affordable. Otherwise it wouldn't be, you wouldn't be able to invest small amounts.
Be successful.
Yeah.
So in summary, don't get too caught up on like ETF versus managed fund is like the golden rule. Which one should I pick? Have a look at like how much money you have to invest, how often you want to invest, whether you want to look at something ethically and then find what suits you. So you might be like, it's Pearler Micro I'll raise initially and then maybe I'll move on to a broker and buy ETFs. But then like you, maybe you're like, I want to actually invest more ethically. So then I'll buy a managed fund as well. Like it can be a journey where you buy both.
And you can always change your mind because I did have managed funds back in the day and now I don't. So
perfect.
That's that.
Yay.
Awesome.
Bye.
Bye.
Thanks so much for joining us. If you found this episode helpful, please rate us 5 stars, write a review, or share with a friend. If you're new to investing, make sure to listen to our first 10 episodes. Follow us at Get Rich Slow Club or Tash at Tash Invests or me at Ana Cristina.
This show was brought to you by Natasha Etchman, who is an authorized representative 1299881 of Guideway Financial Services, AFSL 420367, and Perla, who is an authorized representative 1281540 of Sanlam Private Wealth, AFSL 337927. Knowledge is power, especially when it comes to investing, so make sure you check out our financial services guides and read the product disclosure statement and target market determination for any investments you're considering. See our show notes for more info.